Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 118, and in this episode we are reviewing the performance of the global markets during the 30th week of 2024, and that is from Monday the 22nd to Friday the 26th of July. And without further ado, this is your host Jamhuri, and together let's dive right in. We kick it off in the United States, where the Federal Reserve's preferred measure for inflation eased off slightly in the month of June, and this downward trend raises the probability for a September rate cut. On Friday, the Commerce Department reported that the Personal Consumption Expenditures Price Index increased by 0.1% on a monthly basis and was up by 2.5% over the past 12 months as both readings came out in line with market estimates. This annual rate was down from a rate of 2.6% that was recorded in the previous month of May. Meanwhile, core inflation, which excludes volatile food and energy prices, these showed a monthly increase of 0.2% and an annual increase of 2.6%. In summary, inflation continues to run above the central bank's target rate of 2% as policymakers remain focused on core inflation, which is a better indicator for longer-term inflation trends. Staying in the United States, according to an initial estimate that was released on Thursday by the Commerce Department, economic activity in the United States was considerably stronger than expected during the second quarter of 2024. The gross domestic product, which is a measure of the total goods and services produced in the country, this increased at an annualized pace of 2.8% vis-a-vis market expectations for a growth of 2.1% and compared to an increase of 1.4% that was recorded in the first quarter of 2024. According to the estimates, this growth was mainly driven by consumer spending, which accounts for about 65% of the United States gross domestic product. Moving over to the US stock market, stocks rallied on Friday as Wall Street capped off a turbulent week on a positive note as investors digested the latest data on US inflation and economic growth. Friday's rally was partly driven by an oversold sentiment that was supported by a stronger than expected GDP report, as well as a bullish inflation report that raised expectations for a September rate cut. The Dow Jones Industrial Average rallied 654 points to finish at 40,589, whilst the S&P 500 climbed by 1.1% to end at 5,459, and the Nasdaq Composite gained 1.03% to close at 17,357. For the week, the S&P declined by 0.8%, whilst the Nasdaq lost 2.1% as both indices posted back-to-back weekly losses. Meanwhile, the Dow Jones outperformed during the week as it added 0.8% and recorded its fourth consecutive positive week. And in the U.S. bond market, U.S. Treasury yields fell on Friday after inflation dipped in line with market expectations, cementing the case for a September rate cut. Meanwhile, the Federal Reserve's monetary policy meeting is scheduled for this coming week, and the central bank is widely anticipated to leave its benchmark interest rate unchanged. However, investors are hoping for clear guidance on when the Fed will begin cutting interest rates and how many rate cuts are expected this year. According to the CME FedWatch tool, markets are now pricing in 100% likelihood that the Fed will initiate its first rate cut at its September policy meeting. Consequently, the yield on the benchmark 10-year Treasury fell 6 basis points to 4.19%, whilst the yield on the policy-sensitive 2-year Treasury was down more than 5 basis points at 4.38%. And just for your information, bond yields and prices have an inverted relationship, and 1 basis point is equivalent to 0.01%. And in the commodity markets, the price of crude oil fell more than 1% on Friday, posting a third weekly decline as concerns about Chinese demand outweighed strong economic growth in the United States. The U.S. economy grew by 2.8% in the second quarter of this year, but China, which is the world's largest importer of crude oil, saw its oil imports decline by 10.7% in the 12 months to June, whilst the importation of refined product fell by 32% during the same period. For the week, the price of the U.S. benchmark West Texas Intermediate fell by 3.7% to $77.16 per barrel, but on a year-to-date basis has gained about 7.7%. Meanwhile, the global benchmark Brent crude dropped by 1.8% to $81.13 per barrel, but on a year-to-date basis is ahead by 5.3%. And sliding over to the precious metals market, the price of gold rose 1% on Friday as Treasury yields fell following the latest dip in inflation that increased the certainty that the Federal Reserve will indeed cut rates in September. The Fed's preferred measure of inflation provided fresh evidence that inflation was cooling down, and this in turn fueled expectations that the Fed will begin cutting interest rates in September. And given that lower interest rates reduces the opportunity cost of holding this non-yielding asset, the price of spot gold rose 1% to close the week at $2,388 per ounce. And in the cryptocurrency market, crypto prices rose on Friday following 2 down days in which investors rotated out of risky assets. In particular, Bitcoin spiked on Friday after the latest data showed that inflation had eased off slightly in the month of June, paving the way for a September rate cut. According to Coinmetrics, Ether advanced by 4.5% on Friday, but still registered a weekly loss of 7% to close at $3,262 per Ether. Meanwhile, the price of Bitcoin bounced back on Friday as it rose by 4.7%, but was broadly flat for the week as it closed at $67,800 per coin. And on that note, we now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week, the shilling depreciated significantly versus the US dollar. And according to data obtained from the Central Bank of Kenya, the official exchange rate for the US dollar was quoted at 132.22 compared to 129.99 the previous week. However, in the interbank market, commercial banks were selling the US dollar within a range of between 133 shillings to 137 shillings per dollar. The lowest rate was offered by Stanbic Bank at 133.10, whilst the highest rate was quoted by Equity Bank at 136.75. Meanwhile, the sterling pound was priced at 170.45 and the euro was valued at 143.37. And on the regional front, one Kenyan shilling was changing hands for 28.16 Ugandan shillings and 20.42 Tanzanian shillings, and to the Rwandese franc, it was posted at 9.91. The shilling now appears to be relatively stable against the US dollar. However, this may just be a short-term consolidation following the successful issuance of the latest Eurobond, which helped to avert a potential sovereign default. The fact of the matter is that Kenya's underlying economic fundamentals remain extremely weak, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. And given these fundamentals, I expect that the shilling will continue to remain under pressure for the foreseeable future until such a time that we get our national debt under control. But as we now all know, there are no solutions to excessive debt, just consequences in the form of higher taxes. On foreign exchange reserves, Kenya's usable foreign exchange reserves decreased by $98 million to $7.31 billion, which is equivalent to 3.8 months of import cover. This level of reserves falls below the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing national debt, which has pushed the country to the precipice of a sovereign debt default. And in the money markets, during the past week, the liquidity situation in the interbank market was a tad bit tighter, even though it was supported through open market operations. The interbank rate, which is the rate that banks lend to each other on an overnight basis, this increased marginally by 6 basis points from 13.14% the previous week to 13.20%. On the back of that, the average value that was traded in the interbank market decreased to 21.9 billion shillings, and this was down from 33.2 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the 4.25% cash reserve requirement stood at 26.8 billion shillings. And just for your information, the cash reserve is a statutory requirement that specifies a percentage of total deposits which commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 25th of July, and the central bank received bids totaling 31.6 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 132%. The central bank ended up accepting 22.9 billion shillings, and the results of the auction were as follows. The 91-day rate dipped by about 2 basis points and found its footing at 16% flat, whilst the 182-day rate stayed put at the same level of 16.85%, and the 364-day rate managed to creep up by 2.4 basis points and eventually settled at 16.92%. In the primary bond market, the Central Bank of Kenya has published its prospectus for its August bond issue, in which it is looking to raise 50 billion shillings for the stated purpose of funding infrastructure projects. In this regard, the central bank is offering for sale 2 reopened infrastructure bonds whose terms and conditions are as follows. The first bond is IFB1/2023/6.5. This bond has got 5.8 years left to maturity and a coupon rate at 17.93%. The second bond is IFB1/2023/17. This bond has 15.7 years left to maturity and the coupon rate is at 14.39%. These bonds are now open for sale until Wednesday, the 14th of August, and the value date for these bonds is Monday, the 19th of August. 2 things to note about the infrastructure bonds on offer. The first is that these are amortized bonds, which means that a huge chunk of the principal amount, usually more than 50%, will be repaid before the maturity date. The second is that the interest accrued on infrastructure bonds is exempt from withholding tax as provided for under the Income Tax Act, which explains why these bonds tend to attract a lot of demand, especially from foreign investors. In the secondary bond market, trading activity was on the down low as turnover in the domestic bond market declined by about 46% during the past week. And in the international market, during the past week, the yields on Kenya's Eurobonds were on an upward trajectory, with the yield on the 7-year 2019 Eurobond increasing the most by about 30 basis points, from 10.1% recorded the previous week to 10.40%. And at the Nairobi Securities Exchange, during the week, the equities market was on a downward trajectory, with the NASI being the biggest loser as it fell 4%, whilst the NSE 10, the NSE 25, and the NSE 20 declined by 3.4%, 3.1%, and 1.6% respectively. This takes the year-to-date performance to gains of 19.5% for the NSE 10, 17.2% for the NSE 25, 13.3% for the NASI, and 11% flat for the NSE 20. The market's performance was driven by losses recorded by large-cap stocks such as Safaricom, Kenya Commercial Bank, and Equity Bank, which declined by 8.2%, 7.3%, and 3.4% respectively. This performance was, however, supported by gains recorded by other large-cap stocks such as DTB Bank and Bamburi Cement, which increased marginally by 0.8% and 0.4% respectively. On Kenya's national debt, the information available from the central bank has not yet been updated and still shows Kenya's national debt as at March 2024, which stood at 10.4 trillion shillings, and this was divided between domestic debt, which stood at 5.23 trillion shillings, and foreign external debt that was valued at $39.18 billion, which is equivalent to 5.16 trillion shillings. For your information, Kenya's debt ceiling was converted to a debt anchor that is now set at 55% of the country's gross domestic product. And given that our current debt to GDP ratio is estimated at about 70%, this means that the government is in breach of its own borrowing target. Up next is our topical issue, and this week we are looking at Kenya's borrowing target. The National Assembly is seeking to increase Kenya's borrowing target for the current financial year by 164 billion shillings from the initial amount of 597 billion to 761 billion shillings. The increased borrowing target comes after the Finance Bill 2024 was withdrawn in totality, including the proposed revenue measures that were projected to raise an additional 344 billion shillings. This revenue shortfall has forced the Budget and Appropriations Committee to cut the budget by 121 billion shillings from the original amount of 3.99 trillion shillings to 3.87 trillion shillings. In addition, the Budget Committee has also reduced its target for ordinary revenues by 284 billion shillings to 3.06 trillion shillings. Consequently, the variance between the budgeted revenues and expenditure translates into a budget deficit of about 810 billion shillings. The committee has therefore submitted a supplementary budget in which it has proposed to increase the total borrowing for the current financial year to 761 billion shillings. The bulk of this borrowing will be financed from the domestic market to the tune of 404 billion shillings, whilst the balance of 357 billion shillings will be sourced from the international debt markets. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. I really do appreciate your assistance in this effort. And for your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcasts, Spotify, and Amazon Music. Please consider subscribing so that you can be notified every time I publish a new episode. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourselves a blessed and fantastic week ahead. And remember, you learn more from failure than from success. So keep on trying. Think about it. Thank you, and God bless.